You might have seen the headlines this week about bank stocks getting hammered. On the surface, it seems to stem from one specific incident. Zions Bancorp announced it's taking a big loss and is suing some investment funds for alleged fraud. We're talking about them trying to recover over $60 million. And it's not just them. Western Alliance is after about $100 million from a related group. This news alone sent regional bank stocks into their worst day since April.
It's incredible, isn't it? The immediate market reaction is the real story here. I mean, Zion's stock dropped 13%, and the broader regional bank index fell over 6% in a single day. The alleged fraud is significant, of course, but the speed and the breadth of the sell-off tells you something else is going on. It points to this deep, simmering anxiety in the market that's just waiting for a reason to boil over. It really makes you ask, why is everyone so ready to hit the panic button over what looks like a contained issue?
Right. That's what I'm trying to wrap my head around. Is it just the dollar amount, 60 million here, 100 million there, or is there a deeper fear that makes investors so incredibly jumpy right now? What is it about this specific kind of allegation that sends such a powerful shockwave through the system?
Well, it's not just the numbers. It's what the numbers represent. The allegation is that these investment funds, the Cantor funds, were using revolving credit facilities to buy distressed commercial mortgage loans. That phrase alone, distressed commercial mortgage loans, is a huge red flag for investors right now. It hints at potential rot in a very sensitive part of the economy. So when a bank comes out and says, we think we were defrauded on these types of loans, the market doesn't just hear Zions has a problem. It hears, is this the first crack in a much bigger wall?
That makes sense. But on the other hand, the individuals behind these funds are vehemently denying everything. Their lawyers said the claims are unfounded and misrepresent the facts. How does the market factor that in? It feels like the verdict was delivered by the stock ticker long before any court case could even begin.
That's the reality of a nervous market. The denial is a legal statement for a future battle. The stock drop is an emotional reaction based on present fear. Investors aren't waiting for the legal process to play out. The mere accusation of fraud, especially tied to commercial real estate, is enough to trigger a flight to safety. The Cantor Fund situation, whatever its outcome, has basically served as a stark reminder of how fragile confidence is. It's a specific incident, but it landed on very fertile ground for fear, which makes you wonder how much of this is about today's news versus the ghosts of yesterday.
It definitely feels like this isn't happening in a vacuum. The article I read mentioned the market was already on edge because of recent bankruptcies, like the auto supplier First Brands and the auto lender Tricolor. And of course, it's impossible to forget the chaos from 2023 when Silicon Valley Bank and First Republic collapsed. It feels like those events are casting a very long shadow.
An incredibly long shadow. You can think of it like the market has a form of PTSD from 2023. That crisis of confidence never fully went away. So what we're seeing now isn't just a reaction to the Cantor funds. It's a re-triggering of all the anxiety from last year. Those earlier failures, especially the ones that raised questions about how well banks were vetting their borrowers, what the industry calls underwriting standards, created this credit blow-up narrative. Now, investors are hypersensitive to anything that fits that story, even if the direct links aren't there.
So, stepping back, is this more of a psychological issue where investors are just overreacting based on past trauma? Or are those past events a genuine signal of real, unaddressed problems in the system that are just now bubbling up again?
It's a mix of both, and that's what makes it so tricky. The psychological element is undeniable. Fear is contagious. But those past events did expose genuine weaknesses. For instance, the concern about underwriting standards is very real. After a long period of low interest rates, there's a worry that banks got too comfortable lending to riskier ventures. Now that the economic environment has changed, with tariffs and other pressures, investors are looking at those loans and wondering how many of them are actually solid. They're asking, did the banks do their homework, or were they just chasing yield?
I see. So while the Zions and Cantor funds issue is a new problem, it's scratching at a wound that never really healed from 2023. the history here is everything, which leads to the big debate happening right now inside the industry. Are these just isolated problems, or are they the tip of a much bigger iceberg?
Exactly. The historical context is crucial for understanding why one incident can cause such a panic. It perfectly sets up this fundamental disagreement we're seeing.
And that disagreement is fascinating. On one side, you have bank executives, people like the CFO of US, Bancorp, and the CEO of KeyCorp basically saying, calm down, these are just one-off events, nothing systemic to see here. But then you have one of the most powerful voices in finance, Jamie Dimon from JP Morgan Chase, dropping that incredibly ominous line, when you see one cockroach, there are probably more.
That Jamie Dimon quote is everything. It cuts right through all the corporate PR and reassurances. It crystallizes the entire debate. You have the industry trying to project calm by framing these as isolated idiosyncrasies, but Dimon gives voice to the market's deepest fear, that these aren't random, they're symptoms. The central question now is the one US. Bancorp's CFO actually posed, how many of these idiosyncratic events does it take before you have to admit you're in a cycle?
Let's dig into that cockroach theory. What makes that analogy so powerful in finance? And if he's right, what would those more cockroaches even look like?
The analogy is potent because it implies something hidden. You don't just have one cockroach, you have a hidden infestation. In finance, it means the problem you can see is likely a sign of a much larger, unseen problem festering in the system: bad loans, poor risk management, or widespread effects of economic stress that haven't surfaced yet. If Dimon is right, the more cockroaches could be other regional banks with similar unreported loan issues, or perhaps a wave of defaults in a specific sector like commercial real estate that everyone has been worried about.
But what if the executives are right and these are truly isolated incidents? What's the danger in the market overreacting like this? Is there a cost to this paranoia?
Oh, absolutely. The cost of overreaction is huge. If the market panics based on a false alarm, it can create a self-fulfilling prophecy. Healthy, well-run banks can get punished. They might see their funding costs go up, or depositors get spooked for no good reason. It can stifle lending and investment because everyone becomes too scared to take any risks. This kind of cry wolf paranoia can actually cause the economic slowdown everyone is afraid of.
So it's this incredibly fine line between vigilance and paranoia. And it sounds like the regional banks are the ones walking that tightrope. That article points out that their whole business model is being increasingly challenged by the dominance of the megabanks. And even though their stocks had recovered a bit after 2023, analysts are now calling that recovery fragile. One even said, perception sometimes becomes reality.
That's the core vulnerability for regional banks right there. They are operating in a totally different universe than the mega banks. They don't have the massive diversified portfolios or the implicit too big to fail guarantee. Their health is much more tied to local economies and specific industries. So when a wave of negative sentiment hits the sector, they are far more exposed. And that quote, perception becomes reality, is the gospel truth in banking. If enough people believe a bank is in trouble, they'll pull their money, and that belief will create a real crisis. It's a vicious cycle.
When you say dominance of mega banks, what does that really mean day to day? Is it just about size, or are there other advantages that put the smaller guys on the back foot?
It's about everything. Megabanks have cheaper access to capital. They have massive budgets for technology to make their apps slicker and their operations more efficient. They can attract top talent. And in a crisis, there's a flight to quality, where money naturally flows from smaller, perceived riskier banks to the giants. So regional banks are constantly fighting an uphill battle, trying to compete on customer service and local knowledge, but they are incredibly vulnerable when the market gets spooked.
So if perception is so critical, how does a regional bank even fight back against this? How do you build trust when the market seems pre-programmed to assume the worst?
It is incredibly difficult. They have to be almost perfect in their communication, radically transparent about their loan portfolios and their risk management. They need to over-communicate their stability. But even then, they are somewhat at the mercy of the broader narrative. The current stress might force some consolidation, where stronger regionals acquire weaker ones to create more robust institutions. But it could also just scare away investors and accelerate the decline of smaller, but otherwise healthy players. For these banks, trust isn't a soft metric. It's the most valuable asset they have.
It really seems like three key things are happening at once here. First, investors are just hypersensitive right now. Any hint of credit risk, especially after the last few years, sends a disproportionate shockwave through the market.
Exactly. The tolerance for bad news is basically zero. Second, you have this huge clash of narratives. Is this just a few isolated incidents, as executives hope? Or is it Jamie Dimon's cockroach theory in action, a sign of more trouble to come? The market doesn't know who to believe.
And finally, all of this is exposing the fundamental weakness of regional banks in an era dominated by giants. They are structurally more vulnerable, and this perception becomes reality problem can turn a flicker of doubt into a real firestorm.
That's a perfect summary. It's a collision of past trauma, present uncertainty, and future structural challenges all hitting at the same time.
The recent turbulence in regional bank stocks, triggered by these specific fraud allegations, serves as a potent reminder of the interconnectedness and psychological fragility of financial markets. It forces us to confront not just the facts of a particular case, but the echoes of past crises and the competing narratives shaping our collective understanding of risk. In an era where information spreads instantly and trust is a precious commodity, the line between an isolated incident and a systemic warning becomes increasingly blurred. The ultimate question isn't just about identifying the next cockroach, but about how well our financial institutions and regulatory frameworks are equipped to navigate a landscape where perception can indeed become reality, and a single crack can send tremors through the entire foundation of confidence.